Several years before the financial crisis, Chicago Booth finance professor Raghuram Rajan warned that the housing bubble and growing credit risk could endanger economies worldwide. Now, as head of India's central bank, he worries that we could be setting the stage for the next crisis. In part 2 of his interview with Capital Ideas, Professor Rajan said that loose monetary policy may be inflating asset prices again, which could destabilize the global financial system.
What my worry is basically we're following the same kinds of policies once again that we followed before the great financial crisis. And the rationale is once again the same. We have to stimulate the economy back to growth. And if we can't get sufficient fiscal stimulus or countries have too much debt, let's do it through monetary stimulus and somehow things will become hunky-dory again. And the real question I have is, are we missing something? We've had extraordinarily liberal monetary policies across the world. And with the exception of the United States and to some extent the United Kingdom, both of which are very flexible economies and adapt relatively quickly, the recovery has been extremely weak in other countries. And even in the United States and the United Kingdom, it's not a particularly healthy recovery, 7 years after the crash. And so the question is, are we missing something? Now, some of my colleagues say what we're missing is debt overhang. Some people have too much debt, we need to fix that. But another view is that debt overhang emerged from an attempt to deal through easy monetary policy, easy credit, a longer standing problem. The problem that in many of these countries we have two big forces of change, the effects of globalization and technology on jobs and the aging of populations. And these are changes that have happened in different ways at different points in time, but we're sort of confronting both of them at the same time. And is there something we're missing on what this does to potential growth, what this does to the supply side, what this does to demand, and are we trying to deal with it with tools that we know about without understanding what the real underlying problems are? I can speculate about what the real difficulties are, but I think we need to spend more time without this knee-jerk, let's do easier policy. And my worry is easier policy can only take you so far. At some point, easier policy, instead of creating more lending, creating more growth, is essentially taking growth away from other people. So, for example, before this, the euro had very tight monetary policy relative to the US. So the euro was at very high exchange rates relative to the US and was suffering as a result. Now the euro has embarked on even more accommodative monetary policy, the euro area, and you see the exchange rate plummet. Now, when all the work is being done by exchange rates, or most of the work is being done by exchange rates, we economists don't think that's a particularly healthy way to do things, because what you're doing is drawing off growth from elsewhere. You're depreciating your exchange rate, you're able to export more, that creates more production in your country, but that creates less production elsewhere. This is what we complained about in the 30s when we said countries are deliberately depreciating their exchange rate. It's what we're doing now, but we're doing it through monetary policy. And if it's not creating more domestic demand, but in a sense transferring demand from elsewhere, it's problematic.